Hey, what's up, everybody? June 8th, Tuesday. 10-year Treasury note yield at 152. I told you this was going to happen. Here's the thing, folks, and I don't know how many times I've explained this, but it's worth explaining again. Rates are a function of Fed policy, and anywhere along the term structure reflects Fed policy over the term. Now, we don't know maybe what the Fed's going to do 10 years out, but when the Fed anchors rates as it is doing right now at its current rate of 0 to 25 basis points, and when it says, hey, we're sticking to that rate, all right, out to 2023, there's not a whole lot that the long end can really move because rates are kind of anchored. And this is why you're seeing them, gravitate down. The spike that we saw up to, I don't know, what did it get up to, like 175 on the 10-year? That was in the midst of all these wild, inflation and hyperinflation scenarios that everybody was freaking out about. Since then, with the exception of oil, and I'm a little bit skeptical right now as to the sustainability of this oil rally. We'll see. But in that last week's EIA report, we saw some pretty good declines in gasoline demand, in distillate demand. We saw builds in gasoline inventories. We saw builds in distillate inventories. We saw weak crude oil exports. We saw product exports come down. The only thing really bullish in that report last week was a decline in crude inventories, but that was because imports dropped way down on the week. But other than oil, what I was about to say, other than oil, commodity prices have stopped rising, all right? And I think a lot of that inflation, craziness came at a time last month when we really saw commodities, and a lot of that was just speculation, but there was also what I was talking about the whole time. If you remember, I was talking about the pandemic and the impact to supply and supply chains. Everybody knew about this, but they kind of wove that into a narrative that we're just going to have ever rising inflation or ever rising price increases. And I said, as the economy starts opening up, those supply chain issues are going to dissipate. They're not all gone. I've been reading stuff where there's still a lot of issues out there, but it's getting better. Anyway, that's moot. That's beside the point. Because the real factor here, the real thing you got to think about, the real thing you got to understand is that the Fed sets interest rates. And interest rates anywhere along the term structure are a reflection of Fed policy over the term. And again, okay, we don't know what Fed policy is going to be 10 years out from now, but the Fed's been holding steady now since, what was the final last rate cut? Was that like in last year in March, right? And they've been saying, like, every meeting. It's funny. I did this video once before where I talked about everybody who has, for so long, been telling us, don't fight the Fed, don't fight the Fed. This comes from everybody. It comes from the loony quacks out there all the way right up to the so-called, very serious people on Wall Street. Don't fight the Fed, don't fight the Fed. And yet, they're fighting the Fed. I keep reading this stuff posted on Twitter by economists. Like, why doesn't the Fed raise interest rates? Why doesn't it? It's not, whatever they decide has nothing to do with inflation. If they say we are fixing interest rates at 0 all along the term structure, That means from the shortest overnight interest rate all the way out to 30-year, or beyond that if they wanted to. They can do that, irrespective of where inflation is. I mean, I said this once before, inflation could be 1,000%. They still have the ability to set rates at zero along the entire term structure. They could keep the whole thing flat forever, because that's the power of a monopolist. Monopolist sets a price. There's no other place you can go, all right? It's not like somebody else is setting, dollar-based rates. There's no other place you can go. The U.S. government is the monopoly issuer of the U.S. dollar. Its bank, the Fed, is tasked with setting interest rates, which it does. It has monopoly pricing power to set interest rates, and it could do that. And when it's telling you, like how many times have I said, these policymakers, they tell you what they're going to do. I mean, basically our job is to sit around and to wait until they tell us what they're going to do, and then we act on that. We can formulate some strategy to take advantage of that. And then you just need, mental game and patience. But I mean, they're happy to tell you what they're going to do. They want to tell you what they're going to do. Part of, in the case of the Fed, part of telling you is to signal, to trigger the reaction function on the part of investors. It makes their job even easier. They don't even have to do much work. When they tell you, hey, rates are going to stay where they are for the foreseeable future, the bond market itself will adjust to that. I mean, that's actually, right? That's actually what we're seeing right now. I mean, it's happening kind of grudgingly, because there's a lot of people out there, like I said, even the very serious people on Wall Street, who are just beside themselves as to why the Fed is not raising. They got to raise rates. They got to raise rates. No, they don't. They simply do not. Yesterday, I talked about Janet Yellen, all right, who doesn't seem to understand that we live in an environment of double entry accounting. What does that mean? For every debtor, there is a creditor. For every liability, there is an asset. For every consumer, there is a producer. When she says rate hikes will be good for the country, rate hikes are neither good nor bad for the country. All it is a redistribution of income, all right? If the Fed hikes rates, then creditors and savers, they benefit, and debtors and consumers, they lose out, and vice versa. When the Fed cuts rates, then debtors and consumers benefit, and creditors and savers lose out. It's a redistribution of income. So it's neither good nor bad. It depends on which side of the equation you are on. If you're a creditor and a saver and they raise interest rates, somebody mentioned insurance companies and their portfolios, yeah, then it benefits you. But it doesn't benefit debtors. It makes it harder for them. It doesn't benefit consumers. It makes it harder for them. They have to pay higher prices, or they get shut out of the credit markets. So that's all it is. You can't make a blanket statement like it's going to be good for the whole country or bad for the whole country. By saying something like that, she completely doesn't understand that, it's a balance sheet. There's something on both sides. It balances out. Crazy, man. So anyway, that's it. I don't get, all bent out of shape about monetary policy. Fiscal policy is something I look at because that is a net benefit, all right? Monetary policy is just like a redistribution. Fiscal policy can also be a redistribution too if they do kind of like what Biden wants to do. He thinks he got to tax to get the money and then spend it somewhere else. That's dumb. And that's a lack of understanding of, how the government finance operates under a system like what we have right now with, a sovereign currency issuing country like the United States is. That's just dumb. But like what they did in the last year with the fiscal stimulus, sending out checks, I mean, that's a net addition to the non-government's financial balances. That's a good thing. I mean, we need that. And we need that in a way, frankly, I think we need that in a way that's more equitable in terms of the distribution of how that's done. But we definitely need that. Definitely need that, because the economy is running well below its potential. How do I know that? Because you got a lot of people out of work. And those people could be productive. You got a lot of people out of work. Let me just mention one thing on that work thing, because today that JOLTS, they're the government bureau that, they release how many job openings. So in April, I think the data was for April, maybe it was for May. Anyway, there were 9.82 million job openings. That's a record. But according to the Bureau of Labor Statistics, the BLS, which comes out with the job number every month, there are 9.88 million unemployed. So think about it. These benefit cuts, even if they succeed in doing what these states are hoping they're going to do, which is send people back to work, there's not enough jobs for the number of unemployed. You got 9.82 million job openings, you got 9.88 million unemployed. So what it means is that, again, as I've been saying, the only way I could look at that, I could only come away with the feeling that that's a fiscal cut, a net reduction of income flows, of transfers from the federal government to the non-government. And I don't think that's good, but we'll see. Anyway, I've been talking about that. I did a podcast today, new podcast, which is coming out tomorrow. I get much more in detail on the Basel III effect on gold. You're definitely going to want to hear that. In the meantime, don't forget, go to my website, pitbulleconomics.com, sign up for a 30-day free trial of MMT Trader, and please like and subscribe to my channel, to this video and to the channel if you haven't already done so. Thank you very much. See you tomorrow. Bye.